Schwab Asset Management is proud to sponsor the Advisor Upside podcast with ETF.com. With bond market conditions looking upbeat for 2024, Schwab stands ready with a suite of low-cost fixed income ETFs. Learn more at schwabassetmanagement.com/welcome-ETFs. Welcome to the Advisor Upside podcast, powered by ETF.com. I'm your host, Jeff Benjamin, and I'm talking today with Johan Grahn, head ETF market strategist at Allianz Investment Management. Hey, Johan, how you doing? Thanks for being here.
Great to be here, Jeff.
All right. Let's talk about these suddenly popular buffered ETFs that have been referred to by some as boomer candy because of the way they keep investors exposed to the equity markets by offering some downside protection in exchange for the capping of upside performance. And not to confuse matters too much, there's also this wave of defined outcome ETFs offering 100% downside protection in exchange for cap on the upside performance. Let's start, Johan, by distinguishing the buffered strategies that have been around a little longer with the new downside 100% downside protection products that by my latest count, there's over $1.25 billion across 14 of these ETFs offering 100% downside protection. The most recent is a BlackRock version, but can you kind of break it down for us a little bit, for our audience, distinguishing buffered from what we're referring to as defined outcome?
Yeah. So there's a lot there we can dig into, but maybe just by setting the tables up front, when you talk about a buffered product with a cap, that's really the starting point of the evolution, if you will, in the defined outcome space. And the buffer, essentially what it means is that take an index, take the S&P 500, for example. If you have a 10 or 20% buffer in place, then if the market is down over a certain amount of time, typically over a year, there are other products too, 6 months or 12 months, for example. If the market is down by 10% or less, then as an investor, you stand to lose nothing in that account or in that investment.
Mm-hmm.
And then the price of that buffer, so to speak, or that protection layer that you have against market drops is the cap in terms of how much you can make on the upside. So you can only make X percent, for example. So in a 10% buffer, perhaps you can only make 15% on the upside over 12 months. In a 20% buffer, perhaps you can only make 10% on the upside over 12 months. So that's kind of how the traditional buffer is structured. And then, of course, as it's an ETF, you have the tax advantages at the end of the outcome period. The ETF resets and you get a new cap and a new buffer. Yeah, you don't have to liquidate it and so on and so forth. But when it comes to 100% protection, think about that 10% buffer or the 20% buffer just going all the way down to zero. So you're protecting everything south of zero, so to speak.
Right.
Full protection all the way down. And then since the caps, the more protection you buy, the lower the cap. So in a 100% protection product, the upside is simply less than it would be if you had 20% or 10% of a buffer.
Right. And I want to clarify here too that these are they have specific periods. These things usually run for 12 months, right? They'll have an issue date, and in order to get these benefits, the downside protection and obviously the cap, which might not be considered a benefit, you have to hold to maturity. But you can invest in them at any point during that 12-month cycle, and as long as you have them at maturity, you get that. But some of the wild cards to factor in here, and we're going to get a little bit into the weeds, but I think this is important, is that let's say you buy something that has a 10% downside protection cap. You are protected for the first 10%, but you buy it a couple of months after it was issued and the market's already down 10%. You buy it at that point. Now that could be described as a pretty good strategy, right? Because then no matter how much the market goes down, it's never going to, you're protected all the way. I mean, not no matter how much it goes down, but you're basically starting 10% negative, so your cap is your downside protection is actually extended, correct?
Well, if so, one example would be if the market is down 10%, a few months into the outcome period, if you have a 10% buffer, the ETF itself might be down 5, 6, 7% because it
Mhm.
has a certain beta to the S&P. Now, if you buy it at, let's say you don't own it, but if you buy it at that point, now you have, let's say that it traded down 5%. Now you have a 5% buffer, so to speak, left in
Uh-huh.
that outcome period. But if the market stays where it's at, down 10%, then eventually the price of the ETF is going to make its way back up to the zero line, which means you can make 5% even if the market doesn't move at all.
Hmm.
So that would be an opportunistic trade, so to speak. And then if the market does go up, obviously you can um, make up that first 5%, and then the rest of the returns that go up to wherever the cap is. So you have a higher upside.
Hmm.
So you can trade them opportunistically, like all of the buffered ETFs and the defined outcome ETFs. The question is how tactical you want to be. But I think the cool thing is that when you're buying one, let's say you buy it on day one, you have positive correlation to the S&P 500 when it's going up, and then you have low to zero correlation when the S&P 500 is going down. So you have like the benefit of this from a portfolio implementation standpoint is that just that you get positive correlation when you want it, when the market's going up,
Hmm.
and then you have low to zero correlation when the market's going down, which is exactly when you want that. So it's a terrific diversifier as well. And
Yeah.
one point, by the way, if on the 100, and if you compare and contrast, and you think about, when do you use one over the other, and I think that's where it gets a little interesting as well. If you think about 100% buffer, and for transparency, we don't offer 100% buffer, but it's a great way to get cash off the sideline, for example, because
Hmm.
you have that safety cushion all the way down. The only thing that's chewing up that zero line, if you will, is the fee of the ETF itself. So just keep that in mind, right? It's 100% gross of fees.
Yes.
But then the question is, when would you want to buy, let's say, 20% buffer instead of 100? And if you look, historically, just a very simple statistic. If you look at the past 33 years, since 1990, only 2 of those calendar years, the market has been down by more than 20%. So if you buy a 20% buffer instead, you have higher upside. And with the higher upside, you also get the way that historically it shakes out is that you tend to have a significantly higher upside, but a very similar downside risk, which means that the Sharpe ratios and the risk-adjusted returns are going to be pretty attractive. So it's there's the use case for which type of assets might get allocated to one or the other. And what we see typically is that the cash, quote unquote, cash equivalent might go into 100% buffer, whereas bond equivalent and alternative investments tend to be slid into a 20% buffer.
Right. And these are always pegged to an index. And sometimes they're considered actively managed because of the options trading, but they are index benchmarked. So whenever an investor is buying one of these things, they might be looking at the index, and they might be, if you're going to time it, like is maybe not the best strategy, but it might be for some. That index is what you're looking at the whole time. And I know this is more true with the 100% downside protection than with the ones that have a buffer on the downside, is that on the downside, they will track pretty closely to the index. I mean, they will have a hard time going below the principal level, the initial investment level, because of the way the downside protection is structured. But let's talk a little bit, Johan, about the fees. I mean, these are not cheap, but because you do have some moving parts in there, but you're essentially getting index exposure with the insurance protection. Um, how do you justify the fees when you can get the broad market S&P 500 for 2 basis points, and you've got to pay upwards of
Yeah.
60 for this experience?
Yeah. I mean, there are a couple of things, right? So First of all, it's a structure that you're building around the index. So if it's the
Hmm.
S&P 500, you're 100% right. If you just want to get S&P 500 exposure, you can get that for a couple of basis points. If that's what you're looking for as an investor, then you shouldn't be looking at defined outcome ETFs. The
Hmm.
defined outcome ETFs, they're built for a different purpose. And the first step is to say, well, if I don't want to own the S&P 500, what do I want to own? And typically that is, when you want to be more conservative than having all your money in an equity sleeve or an equity portfolio.
Hmm.
And typically and traditionally, the answer has been, well, I'm going to move some of my equities to bonds. So now you have an option to say, look, I'm not excited about 5% yield from my bond portfolio. I saw in 2022 what could happen. We don't really know what the Fed is going to do. All I know is that I am more or less um, uh, guaranteed to lower the expected return, because equity risk premia tend to come with higher returns relative to fixed income risk premia over time. So now what you can do, you can say, well, I know I don't want to be 100% in equities. I don't really love bonds. I can buy a buffer ETF instead. So
Right.
now you maintain your equity risk premia allocation, but you're having an instant buffer on the downside. So you have instantaneous protection that you build in, but you have long-term opportunity. Most people, when they start thinking about becoming more conservative, they still have 10, 20, 30 years left, of investing. They want the protection right away, the buffer. I want it today, but I don't want to give up all the upside potential. That's the beauty, or one of the beauties, of buffered ETFs.
Hmm.
And to answer your question, is it then expensive to have that opportunity set built into your overall asset allocation strategy, or is it not? So the comparison should really be not to the S&P 500, the performance comparison or the cost, but rather to what you would have otherwise bought. And in this case, in my example, and I'll finish here in a second. In this example, instead of buying, and I'm saying fixed income, it could be real estate, it could be anything, alternatives, long short equity, whatever you want. That's the benchmark that you're comparing to. So yes, the structured defined outcome buffered ETF might be more expensive than equity, but you get a lot more upside potential than you would have been receiving from one of those other allocations. And in terms of structuring this, yes, it's an options package. Um, but in an ETF, you can manage this allocation across hundreds or thousands of accounts with one ticker, as opposed to buying literally like thousands of options legs and maintaining and looking over that. And with options themselves, you also have maturity, which means you have a taxable event if they're in a gain position. You wash all that away by buying an ETF. So there's a lot of value that
Uh-huh.
goes into having that structure available. And then, of course, the trading, and which we do in house, it gets pretty sophisticated, it's customized, et cetera, et cetera.
Yeah, I mean, it is a good point that these products, whether they're you use the buffered or defined outcome ETFs, they are not necessarily a one-for-one trade-off with fixed income. I'm sorry, with equities, even though they do
Correct.
have the underlying benchmark in the equity space. I kind of like what you say about if you use them as a proxy for fixed income, it's a different way to look at them, or use them as a proxy for anything other than equities. If you want to hear more analysis and expert opinion about what's going on in the markets and the world of ETFs, make sure to also subscribe to and follow Exchange Traded Fridays, brought to you by ETF.com. Do you think that there's a market for these strategies for people that want to take some of the equity market risk off, but still want to feel like they're in the equity markets? I'm thinking, imagine you've got somebody. I got to believe these things are most attractive to people in or near retirement. Maybe that's why they're referred to as boomer candy. But if you have somebody that has maybe they're just entered retirement, 65 years old, they've got maybe 60%, maybe 50% in the equity markets, the rest spread across other income products. And maybe they want to go down to 25% full long exposure in the equity markets and put the other 25% into something like this. I mean, is that a strategy that you see as plausible?
I do, yeah, and we actually see it applied in many places, and it's a growing space, as you know, and advisors are adopting this, you know, and it takes time for the textbooks to be rewritten to cover these type of strategies, right? Like defined outcome strategies have been around for decades in structured notes, for example.
Hmm.
So the concept of investing like this isn't really new, but the liquidity that comes with the ETF market, that is the new component. And let's face it, right? Like most people that have saved up for retirement, let's say that they have, you know, that are looking for advice. Let's say they
Mm-hmm.
have a million or two, or maybe up to five. Most of that is in liquid assets. So, and has been managed in a liquid way. And that's where this newness comes in. And when you can think about having one asset class versus another, absolutely. We see like more conservative investments with, to your point, if you have 25% equity or and 75% fixed income, or you want to cut from 50-50 to something more conservative, you have this optionality now. You don't have to like buy something that is going to create illiquidity in your portfolio or taxable events or, you know, different reporting standards. You can actually now give yourself an opportunity not to just, you know, adhere to this, like call it, you know, the 4 or 5% rule, where you just
Uh-huh.
4 or 5%, so you can take 4 or 5% and live, you know, like on that asset base forever in theory. Now you actually have an opportunity to do that. You take your 4 or 5%, but you've given yourself an opportunity to make a lot more. So you
Uh-huh.
can actually increase your standard of
Right.
living as you're aging. And that is a new, really cool evolutionary outcome of these type of products.
We talked about buying these at various points after the issue date. Um, what about holding to maturity? Is there, I mean, it seems to me that whenever you buy these, one of these, whether it's buffered or defined outcome that has a specific maturation date, if it seems like whenever you buy them, there's no upside to not holding them to maturity, or is there?
So if I understand your question correctly, the answer might be that most investors are better off holding in a strategic way, strategic allocation, versus trading tactically. If you want to trade tactically or opportunistically, first of all, you need to have a market view and you have to make
Right.
decisions.
Let me
Yeah,
clarify, Johan. I mean, we already kind of dabbled on the idea of maybe buying in when the market is down below the threshold level of the downside protection or something like that, or into that threshold level.
yeah.
What I'm asking is, what about once you buy it, whenever that is, you want to hold this thing to maturity because that's how you get the full package benefit, right?
That's right. Yes. So if you, so the simple example might be if you put $1 million into one of these ETFs and it has a 10% buffer and a 15% cap, let's say,
Hmm.
and over this outcome period, if the market is up 20%, you're not going to get 20, right? But you will get 15, but you won't
Right.
get the full 15 until the end of the outcome period.
Right.
The price of the ETF will gradually creep up to that 15% return over
Hmm.
time.
Okay. That's the point. I think that's not a small distinction that people would need to know. You can buy into these things at any time, but you know, it's like the Hotel California. You can check out anytime you want, but you can never leave. You have to stay to maturity to get the, you know,
Hopefully
that's a
there is no hopefully there's no reason to leave, Jeff.
right. Well, yeah, exactly. I mean, it's probably that was a clunky analogy anyway, but anyway,
Great song though. Yeah.
it is, you know, like I said, the point is these promises that are out there about, you know, downside protection and a, you know, cap on the upside, all that stuff, it gradually builds throughout the term of these ETFs, and you have to stay to the end to get it all. One other thing I want to talk about before I let you go is the dividend income. There are let's say you have one of these buffered ETFs that is benchmarked to the S&P 500. The S&P 500 has dividend income, as you know, which is part of the total return. But you're not getting that dividend income if you're investing in one of these buffered products. Let's say there's a cap, upside cap of 15%, and the S&P 500 has a total return of 15% over that 12-month period. These buffered ETFs are going to give you 15% minus the dividend income, correct?
That's correct. Yeah. So you might get, plus or minus 13 and a half in that
Right.
example. So I get this question every now and then, and the short answer is that by giving away, quote unquote, that 1.1.5%, whatever the actual dividend is today on the S&P 500 total return, you can make that cap higher. So otherwise, if that return was part of it, your cap would have been 13.5 instead of 15, give or take, right? I'm estimating the numbers a little bit. But the point is that you get a higher cap, in other words, a higher upside potential. And that's important because when the market rallies more strongly, those returns matter more to your ultimate journey, if you will, your total compound return profile over time. So given that first, 1.5% of the returns away, the dividend piece, if you will, gives you an opportunity to actually expand for when the markets do come up. And the other part of it is like you should never, and I know we touched on this earlier, but you really shouldn't be thinking about these S&P 500 ETFs as with the benchmark of the S&P 500. And definitely not the S&P 500 total return index, because that's not why you buy them. Remember, you buy them instead of buying something other than the S&P 500, and that other thing is your true benchmark.
Yeah, there's a ton of nuance here, and that's why I love this category so much. I've written a bunch of stories on it and had a bunch of conversations on it, and I think it's a fascinating tool, and there's, especially when you find out how many different ways there are to use it. In wrapping up here, Johan, I mean, since you took the time, you walked us all through it, but you were a gentleman and weren't, promoting your own stuff there at Allianz, but I know you have some of these products. So why don't you give us just a brief summary of what Allianz has in the buffered space?
Yeah, I appreciate that. So so briefly, and by the way, if anyone that might be listening that's interested, they can come to our website, Allianz, IMETFs.com. We have everything in a product table outlined there. But so we have a 10%. Everything we do is on the S&P 500. First of all, we have a 10% buffer and a 20% buffer with a 12-month outcome period that are capped on the upside. We also have a 10% buffer on the S&P 500 over a 6-month outcome period, also with a cap on the upside. We have a floor product in which you can lose no more than 5%, and then you're protected. So instead of being protected at 100%, you're protected at 95%. And obviously you have higher upside versus 100% cap product, since the first 5 are the most expensive to hedge. Either way, that gets in the weed again. We also have what's actually most interesting right now, and what I would encourage anyone to look at. Time will this out, but we have an uncapped buffer ETF too, with a 15% buffer. And what it does, instead of capping the upside, we use the first few percentage points. In this case, it's about 3.5% of the first returns of the S&P 500 to, quote unquote, pay for that 15% buffer. So it's the reverse of a capped buffer. And we're the only firm that actually has this product out there. And this is the one that I think is really fascinating, because when you look at long-term investing, the returns that matter the most are those that are the tall towers, if you will, in the bar chart. Those are the ones that give you that long-term average, give or take 10% return of the S&P 500. Without those big outlier years, you don't get that. So now you have an opportunity to buy into a product with an instant 15% buffer, keeping in mind, like, you want to be a little bit more conservative than the S&P, 15% buffer right off the bat. And then you have huge upside potential over the next 5, 10, 15, 20 years. Because when the market's up, let's say 30%, for example, you get 27.
Okay. If
the market is up 15, you get 12 and a half or whatever the numbers are. But those outsized years, that's what compounds over time and can really, really make a difference in your portfolio.
All right. Good stuff, Johan. We're going to leave it at that. I want to thank you for participating today. Johan Grahn, Head ETF Market Strategist at Allianz Investment Management. I'm Jeff Benjamin, Wealth Management Editor here at ETF.com. You can follow me on X. My handle is @BenjiWriter. You can email me if you've got an idea for a podcast or a story or some breaking news. My email is jeff.benjamin@ETF.com. And I encourage you all to go to ETF.com. Check out our Advisor Center. We've got all kinds of stuff there specifically tailored to the financial advisory space. Until next time, thank you very much. Schwab Asset Management is proud to sponsor the Advisor Upside podcast with ETF.com. With bond market conditions looking upbeat for 2024, Schwab stands ready with a suite of low-cost fixed income ETFs. Learn more at schwabassetmanagement.com/welcome-ETFs.